Now, getting on to the aspect of total income, how to arrive at the total income, steps for computation of your total income and tax liability. I have already told you in the beginning. I'm just going to give you a complete step-by-step approach that has to be followed for arriving at the total income of an individual. The total income of an individual is going to be determined by following these 9 steps. First one, determine the residential status of an individual. Then, depending on that, classify the income under different heads, compute income under each of the heads, club the income. Suppose if you have got any losses, such losses can be carried forward or can be set off against different other heads. So setting off, carry forward and setting off of other losses can also happen. Then compute your total gross income or gross total income. From there, if at all an individual is eligible, can go for deductions from the gross total income. And then computation of taxable income will be in force. From your computation of taxable income, your net liability of taxes are going to be determined. Now, these steps are going to be discussed out in detail. First one, determination of the residential status. We will deal about the how to determine the residential status of an individual with some numerical examples also in the next session. But for now, the residential status of the person has to be determined as the first step of ascertaining the income of an individual. The residential status as per the Income Tax Act 1961 can be classified into 3 actually. Okay, one is going to be, in the case of an individual, the duration for which he is present in India, that is going to determine the residential status of an individual. Okay, suppose if an individual is staying for a specified number of days in a year, he is going to be categorized as resident Indian. If he is less than the specified number of days, he can be non-resident Indian or resident but ordinary resident Indian, something like that. So, depending on the number of days a person is living in India, is staying in India, that makes the most important point in determining the residential status of an individual. So, based on the number of days spent by a person in India, he may be a resident Indian but ordinary resident Indian. At the same time, he can be resident but not an ordinary resident Indian. There is a subtle difference between these two things. The conditions which we are going to look in future, that will determine that. And the non-resident Indian. Okay, so 3 categorization of residential status are going to be there as far as individual is concerned. This residential status of a person determines the taxability of the income. For example, income earned and received outside India will not be taxable in the hands of a non-resident Indian. But the same thing will be taxable in case of a resident Indian. Resident and ordinary resident Indian. Okay, again, a deemed resident is always a resident but not ordinary resident in India. So, depending on what is the status of the residential status of an individual, certain income is taxable, certain income is not taxable, and that's the reason why the first step we have to determine what is going to be the residential status of an individual. As I told you, this slide or this particular diagram will give you an understanding on what are different categorization of different categorizations of individuals are concerned. Then residential status individuals are concerned. Then classification of income under different heads. A person may earn income from different sources. Sometimes, and the same individual can have multiple sources of income. But majority of the time, one single source of income is going to be the source of income for an individual. A salaried person who earns income by way of salary, suppose if he is going to be on an employment, he also get an interest from the bank savings account or a fixed deposit. And suppose if he has got a share, he may be getting a dividend. Something like when he is going to have a house property, maybe he would have earned, or ancestral properties could be there. He would have rented it, so house property, rent from the house property can be there. So income from house properties can also be there. And the same house property can be sold out, and in the meantime he may be getting something called as a capital gain. So multiple sources of income could be possible for an individual. So in that scenario, we have to determine what is going to be the income, gross total income of an individual from different sources that an individual can have. So under the Income Tax Act 1961, for computation of total income, all income of taxpayer are classified into 5 different heads of income. This is what it is. Under the head of salaries, income from house property, profits or gains from the business or profession, capital gains, income from capital gains, and chargeable under different other income, other sources of income. So an individual can have income from all these sources, possible to have it, but then multiple sources could be there, but at least from one source he will definitely have an income. So such income, which is going to be under all any one of these particular heads, will have to be computed, will have to be classified, and it should be considered for payment of income tax. The taxpayer has to classify the income earned under the relevant head of income, and he has to compute his taxes. Okay, I'll reiterate on the 5 different heads of income. 1, salaried person earns his taxable income under salary. Rental income could be possible for the house property, person who has house property. Who is doing a business or profession, they can have income from profits or gains from business or profession. And suppose if you are going to have a sale of a capital asset, like land or a building or something like that, there the shares, even shares, your financial securities, that also will come under the head of your capital gains. And any other things like interest, dividend, all these things will be treated under your income from other sources. Okay, so these are all different 5 income sources of income that an individual can have. So to give you an idea, 5 different heads are listed down in this particular slide. Salaries, income from house property, income from business, profits or losses from business, income from capital gain, and income from other sources. Now, computation of income under each head has to be done. Income is to be computed in accordance with the provisions governing the particular head of income. Because sometimes when you are going to have salary, exemptions might be given to the salaried people. Some of the exemptions might be given to the salaried people alone. Some of the exemptions might be given to the persons who are doing business alone. So, to give effect for that, exemptions, to treat these exemptions separately, there are certain incomes which are wholly exempted from income tax. So, these incomes have to be excluded and will not be forming part of your total income. Also, some incomes are partially exempted from income taxes. So, these incomes are excluded only to the extent of the limits specified in the Act. For example, let us say housing allowances. Some of the allowances are going to be completely taxable, some of the allowances are partly taxable. So, you will have to classify those things under different heads, and you should take into consideration only those parts that are going to be taxable by a person, on a person. Okay. And deductions, there are deductions and allowances prescribed under each one of the head. Separately it is given out. So, these deductions have to be considered before arriving at the net income chargeable under each one of the head separately. That's why you have been given with 5 different heads of income and 5 different classification of income. Next step, it has to be clubbing. In case individuals or income tax is leviable on a slab system on the total income, the tax system is progressive. As income increases, you will have to pay more taxes, and the income decreases, you will have to pay less taxes. Some taxpayers are going to be higher income categories or brackets, and they have to the tendency to divert some of their portions of their income to their spouses and minor childs, etc., to minimize this tax burden. So, this kind of clubbing of income can happen in order to prevent such avoidance of taxes and things like that. The clubbing of income, provisions relating to the clubbing of income have been incorporated in the Act, under which the income arising to certain persons like spouse, minor child and things like that have to be clubbed out, and it has to be shown as one person's income according to the Income Tax Act. As I told you in the earlier session, there can be setting off or carry forward of income or losses from one head to the other. Carry forward from one year to the other can also happen. This has to be effected upon. See, for example, if I have got a house property, as I told you in the beginning, for construction I would have taken a loan, and this loan, repayment of loan and the interest payment is going to be a expenditure for me or loss for me. Such losses can be offsetted by the other income that I've got. So, that kind of a setting off and offsetting of the losses can be taken up as the next step, step number 5. And step number 6 is going to be the original computation of total income. After taking into account different heads, after deductions, exemptions under different heads, after clubbing off, after setting off all the allowances, deductions, after all these things are made, your total income is going to be arrived, and that is going to be called as gross total income of an individual. For example, there can be deductions, there can be some exemptions, For example, as far as deductions are concerned, with respect to in respect of certain payments, the exemptions can be, deductions can be given. For example, you pay for your income tax, life insurance plan, or you pay for your contribution to provident fund. These are going to be given as certain exemptions to your payment of taxes. Likewise, there are certain, with respect to certain income, also sometimes the exemptions can be given or deductions can be given. For example, the employment of new employees, the royalty income, etc. are going to be, etc. for the authors. For certain books other than the textbooks and things like that, there can be some exemptions given. And with respect of other income, the deductions can be in the form of interest on deposits on savings bank account, interest on deposit after a certain particular limit. Within that particular limit, if you are going to get the interest and things like that, say for example 10,000 rupees a year or so, within that income limit, you may be exempted, or the deductions can be given out. Other deductions like deductions in case of let us say personal disabilities, or maybe for certain expenditures, some deductions can be given. So that all these deductions are going to be deducted out, and you are going to arrive at the total income of an individual. So comprehensively, this particular diagram will give you the steps involved in arriving at the total income, or whatever steps that I was saying you as of now, till now, this is going to be pictorially given out, and you are going to arrive at the total income. After the total income, applicable tax rates are going to be given out. Now, I will go to yes. This is a model for the tax rates. Applicable tax rates for individuals, undivided families, association of persons, body of individuals. For the assessment year 23-24, the tax rate goes like this. When there is going to be a total income does not exceed 2,50,000 rupees, you need not pay any taxes. And the tax rate on the next column, the second column is given out, need not pay any taxes. Where the total income exceeds 2.5 lakhs but does not exceed 5 lakhs, on that amount you will have to pay 5% of it. So you will have to pay 12,500 rupees. Suppose if your income is going to be up to 5 lakhs. Where the total income exceeds rupees 5 lakhs and below 10 lakh rupees, above 5 lakhs, whatever income comes, you will have to pay 20% of it plus 12,500 rupees. And above 10 lakh rupees, 1,12,500 rupees plus 30% of the amount above your amount exceeding 10 lakh rupees have to be paid out. So this indicates that there is going to be a progressive system of taxes are going to be taken into consideration. With that, we will stop this session, and we will come back to the next session during the next week for various definitions and things like that. And so we will end the session now, and all the best.